Rohr here with an early morning concise highlight on Monday, June 16th, 2014. And it's going to be a concise highlight today because not much at all has changed since our Global View video analysis back on Friday morning. It is currently 7 a.m. U.S. Central Time. And what we have to keep in mind is that even before the problems surfaced on the geopolitical front with what all is going on in Iraq right now, last week ended on fairly weak data, especially considering U.S. Michigan sentiment. Preliminary was weaker than expected, and going back to Thursday, U.S. retail sales came in weak once again. Now, it's been a light reporting day so far, and we're headed into U.S. Empire manufacturing, industrial production, and the NAHB housing market index. However, it is generally a fairly light reporting week, especially with a only minimal amount of U.S. data, but there is a major U.S. influence, of course, coming up on Wednesday afternoon in the form of the FOMC rate decision, and there will be the monetary policy press conference as well. So with that, we take a look at the short-term chart of the S&P 500, hourly on the left, 30-minute on the right. The volume is moving over to September, but we wanted one more look at the June contract to highlight some of the things that went on, because this is still going to be the lead contract on the weekly chart, and we'll be switching over to September as of tomorrow. But for right now, what we have is a market that broke down going back to last Thursday, when the market had tested the gap and the other supports, the old oscillator levels and the channel, most importantly, down into the 1938 level Wednesday, but gapped lower on Thursday, left a down break below 1942, and that led to a rather precipitous slide back to the next lower level, beginning congestion at 1925, which was a level, of course, we had been looking for. And not surprising, two things in a bear market or a bear swing, that when there really wasn't much below the 1937-38 level until 25, that the market could get there all in one day. And secondly, that, again, without much previous activity between there and the 37 to 38 level, that the market could bounce right back and test that resistance. Now, currently, this market is off about 6 on the day, back around the 1930 area, and we consider that the continuing problems in the Middle East, some new pressures from evidently Russia starting to squeeze Ukraine once again over its arrears on its gas bill, and starting to limit gas supplies to Ukraine, are all going to be pressure points for this market. But for right now, the short-term indicators don't tell us much more. They're a bit betwixt and between, and we're going to move over to the intermediate-term chart for a view of how this is playing out on that level. And at least so far, it is a limited reaction in what has been a major bull trend, of course, and even a major upswing since the market gapped above 1900 going back several weeks ago. And of course, that is what set up that 1938 objective. The market overran 2 weeks ago and reacted back down somewhat below to close last week. And that's important. Markets that overrun objectives and then react below them are giving you a sign that they might be ready for a bit more of a dip. And given the geopolitical and economic context, we're not surprised that this could be happening right now, especially after the indications from Bank of England Governor Carney on Thursday evening that they might be ready not only to not be more accommodative, but to actually raise rates possibly sooner than a lot of people think. But in terms of lower supports, there's still plenty of support down into that gap at 1900. That's both on the gap itself, weekly moving averages, etc. And it's important to keep in mind that as we head toward the expiration at the end of this week, basically Thursday's close is when the June contract stops being the effective lead contract, so into the close of the week we'll be picking up September. That's at $6 lower than this contract, so that'll bring the market more quickly into a test of 1900. But as you can see, even on the June contract, that support will be important as Fibonacci retracement. Even if we go $6 lower here into the 19 low 1990s, that's a lot of congestion on the weekly chart and ultimately on the September chart as well. We'll be showing you shortly.